Hello, welcome everyone.
Hold on. Okay, live.
Hello, welcome everyone. If you've just joined us, you've missed out on the opening address and the keynote speech this morning, but not to worry. All the sessions have been recorded and will be available on the same platform for on-demand viewing after the end of today's event. And the next session will always pop up at the top. If you don't see it, not to worry, just click on the schedule and you'll be able to head to the current session. But I am glad that you are right here with us right now, because we are very honored to have three of the best financial minds in the country with us in this panel. They've been regularly featured on TV, on radio, online, and you get to hear them speak live today. First up, we'd like to introduce Mr. Seng who is currently a director at CIMB Bank, but has worked for decades as a regional economist, and he is one of the most popular economists in Singapore. He's legendary for being able to explain complex ideas in a way that's simple enough even for laymen like myself to comprehend, and he'll be helping us understand the state of the economy today. We also have Mr. David Guo, the co-founder of The Smart Investor, a website that educates people on how to grow their wealth through stock investing. And he was also previously the CEO of the Motley Fool Singapore. His advice and approach to investing has transformed the lives of thousands of people, including myself. And he used to write a weekly bulletin that was read by over 140,000 people every week. Last but certainly not least, we have Mr. Geoff Howie, the Singapore Exchange's market strategist. He's been working in financial markets for over 2 decades. And I dare say nobody else knows as much about the offerings available on the Singapore Exchange as Geoff. He's also the author of the SGX My Gateway report, which highlights major developments in the local market. And if you've not read that, well, you should subscribe right after this. You've been missing out on a lot. Welcome, gentlemen. So for our viewers, if you're watching right now, please do type your questions into the comments box below, and we'll do our best to answer them. But right now, we'd like to start by asking Seng about where the global economy is right now, 1 year into an unprecedented global pandemic. So the world has fundamentally changed, hasn't it? So has the recovery started, Seng Will vaccinations really make a difference? What do you think?
A simple answer. Good morning, everybody. Nice to be with everybody. The three amigos come to put on the song and dance today with hopefully some answers as well. Now, a very simple answer. Questions, I think, will be answered as we move along. Take a step back. This time last year, we obviously were all panicking. Have we gone for the great toilet roll rush yet at that point in time? Probably not. Probably not. I think that was much later on. When you look back at that, we can obviously laugh about it. Last year, obviously, as it unfolded, very brutal year. The pandemic was a tail risk that became the base case. Roll forward this year, yes, we are far better informed. We have vaccine treatment rollout. We have treatment hopes. We have massive wall of liquidity as government roll out, I suppose, endless measures to support the economy from collapsing completely. Central banks ease interest rate to next to nothing as far as cost of funding are concerned. So that helped at least put a cushion on the floor. Today, I must say, better times, but obviously, as we can see, not all industry has recovered. How do I describe this year's growth prospect? I think some say K, I would say it's a little bit more complex than that. Probably like the spread of your palm, where certain industry, you're talking about aviation, for instance, travel still like this. Up there, your new industries, modern services, ICT, digitization, taking hold far more and very comprehensively across the world. You don't have to look too far around your neighborhood to see how that has changed. And obviously little things in here, different layers. So it's really like this, palm. When we'll get to this on the way up, I think we're still some way away from that one. Obviously, much will still depends on vaccine rollout, geopolitical risk, etc., etc. So the simple, straight answer to your, I suppose, simple answer to the question really is better now, but still a lot more to be done. There's hope that this year will be a healthier year, which gives then greater confidence to businesses, and our support continue to be, I think, there to sustain the recovery, we should hopefully see a more broad-based sustained recovery from the second half and into 2022. So base case is, let's say, round it up. Last year, global economy contracted, just simplify, 5%. This year, it may do 5% or more. But remember, when you drop 5% and you recover 5%, you haven't gone back to where you have fallen from. And for some industries, it's still obviously well behind. So better. So our base case, maybe around 65% probability is a much better year as we head into the tail end and into 2022.
Thank you very much, Seng. So it's very reassuring to hear from you. If you think that we're going to be doing better, I think I've got a bit of confidence. We're going to move on to David right now. David is the #1 proponent I know of getting invested and staying invested. When people ask him when the best time is to enter the market, his standard answer is yesterday. I know this is a trading festival, David, but how has the buy and hold strategy worked out for investors over the last 12 months?
Well, Edward, I mean, just because you are a buy and hold investor doesn't mean you're a boring person, right? I mean, you don't really need to be a trader to actually enjoy investing. And I think those people who were brave enough to stay in the market over the last 12 months, they won't have been disappointed. And I go back and say what I've always said previously, which is that you need to build a diversified portfolio. Now, obviously, not all your stocks will be doing particularly well. Some of them will have suffered as a result of the pandemic, but there are going to be others that will have done exceedingly well. So, I mean, to give you a good example, I mean, if you had a portfolio that was made up of, say, Malaysian glove makers, and you had some stock market bourses in there, stock exchanges from around the world, and then you've also got some things like REITs in there, well, the REITs haven't done that great, nor have the banks. But then at the other end, I mean, if you have got some glove makers and you have got some stock exchanges in there, they will have done fabulously well. So within that entire portfolio, depending upon how you apportion the different shares in that portfolio, you will find that 2020 wasn't really that bad a year after all. And many of the companies, despite what some people might have said that, oh, you know, they cut back on their dividends. Well, some of them have increased their dividends. They've jacked up their dividends. And some have even issued bonus shares because they've done so well. So the key really, Edward, is to have a diversified portfolio so that if you make your portfolio strong enough, it will be able to withstand anything. And even as we come into 2021, we see there is a lot of volatility in the market. But I have to say that I don't fully understand why people are so concerned about higher bond yields at the moment. I understand the fact that people are concerned that maybe there may be inflation in the system and that those bonds are not really reflecting what interest rates may do in the future. But ultimately, again, I say if you have got stocks in your portfolio, as opposed to having cash and a lot of bonds in there, if we do get inflation, those companies that are able to increase their prices because they have pricing power, they will do well. And guess what, Edward? Because they're going to do well, they're going to make more profits. And guess what? If they have more profits, they're going to pay you more dividends. So as an income investor, I haven't been disappointed at all with 2020. Sure, some stocks have cut back, some stocks have not been able to pay a dividend, but the rest of them have. So in total, I would say 2020 wasn't a bad year at all for investors. And I maintain that the best time to buy stocks is yesterday.
I love talking to David because every time I listen to him, I go and rebalance my portfolio and I feel a bit better about my retirement. It's great. And also, folks, if you just joined us, we're speaking to Mr. Song Seng Woon, Mr. David Koh, and Mr. Geoff Howie. If you have questions for them, please do put them in the comments section. We're going to move on to Geoff right now because Geoff, economy is starting to come back. Stocks are doing great, but all through last year, there was quite a bit of whinging and whining online about the Singapore market being a laggard compared to other regional and global markets. You're the market strategist for the SGX, so I'd like to give you the time right now to address that.
Sure, Edward, thank you. The benchmarks globally, not just in Singapore, but regionally and globally, they've all been driven by these staunch sector trends. So much of what's happened in the global stock market over the 12 months has been in unison and very much aligned, pending on you know, how much a benchmark has exposure to a certain sector. So as you know, our STI benchmark, which is a 40% weighted index to banks, has really moved in line with what global banks have been doing. And it's so much so that the share price of DBS, UOB, OCBC have been 90% correlated with most global bank indices. It's just like Singapore Airlines, which has been their STI's best performer so far in the year to date, has been 90% correlated with the Bloomberg World Airlines Index. It's because so much of the world performance hinges on two things. It hinges on our ability to overcome the coronavirus. And number two, it's being fueled by this extraordinary money supply growth, which is at 100-year highs in the US, and money supply obviously up 40% in the ECB. So it's funny you say the groaning, because I don't know if it was really groaning, because our participation in the STI ETF last year reached record levels. David was mentioning that, you know, the buy and hold philosophy does maintain and stay true. And we saw that almost to a textbook effect last year. So we launched a STI ETF initially back in 2002 with State Street. We launched another one in the beginning of 2009 with now Nikko AM. And those two ETFs together, it took 17 years for those two ETFs to reach a Singapore $1 billion asset under management threshold. It then took a subsequent 17 months for those two ETFs to reach $2 billion in assets under management, which occurred during the market weakness last year. And we reached that milestone in November of last year. So globally, investors, obviously, I can speak for locally, investors and to an extent globally, have been looking to buy in the weakness, but at the same time, the money supply fuel that's gone into global stock markets has seen an increase in trading liquidity. And for many, I guess, traders, not investors, their stock market has provided a good means to participate in big moves, particularly as I said, the overarching hinging theme is the coronavirus, which most traders get. Most traders understand that you've got medical supply stocks, you've got stocks with digital technologies, you've got stocks that are effectively industrial supply chain leaders that can have been less impacted from the coronavirus, and therefore have been able to provide somewhat of a return during the tough times. And then they can also identify those stocks such as financial services, such as consumer staples, travel and leisure, aviation related stocks that haven't fared so well. And then in that trading world, you can look at the week and see, okay, are we beating this coronavirus? Are we not? And then you can see there has been quite a bit of, I guess, more of the short-term trading activity around some of those big stocks that tend to have moved more and have more, I guess, beta with the coronavirus over the last 12 months or so. So in essence, I guess, no need to moan. We do have something for everyone, and certainly the statistics show that a lot of investors and traders have re-engaged with the market over the last 12 months or so.
Yeah, I was quite surprised to hear that also, especially, and for those of you who are still holding Singapore stocks and have been doing so for the last few weeks or in the recent months, I think you've been very, very happy also. Thanks for that, Geoff. We're going to go back to Seng Woon, and something interesting that Geoff mentioned just now was about Singapore Airlines. This stock is popping back to all-time highs. Wow, Seng Woon, we're looking at a situation, at least locally, where we're going to have a large proportion of our population vaccinated. And on top of that, in Singapore, we're going to have the same rigid protocols with regards to screening, with regards to quarantine and control of travelers. Do you think that's going to put us ahead of our neighbors? I mean, if we look at, for example, Malaysia and Indonesia, they're setting up a travel bubble. How does that look for us, though?
Fingers crossed. I suppose, again, we must never forget Singapore is a tiny city-state, very small, 700, almost 30 square kilometers. All our growth almost from trade in goods and services. So we have to stay connected, which is why, you and I can only do so much as far as our F&B sector is concerned or local businesses is concerned. We have to stay connected. So we really have to take charge of the situation, whether it is containing the virus here or whether it is about, linking up to the rest of the world in a controlled manner. So hence we've got, the rollout of vaccination passports, etc. It's really all about how we can hope to give a lift to the industries and sectors that has been still and is still lagging behind. So remember, back to these 5 pumps, it is these two, for instance, aviation travel, that we want to at least move up. So hopefully that happens. A lot obviously will depend on Singapore Inc. being able to show the world it is safe to travel through Singapore, it is safe to have meeting in Singapore, it is safe essentially to travel to Singapore. So if that can happen, then obviously whether you are in the retail trade or whether you're in hospitality or whether in transportation, you'll get a bit of a lift on that side. So obviously confidence has returned, more so as vaccination rollout, but obviously different rate of vaccination, different rollout has different impact around the region. We're still very careful about how we open up, but we still need to open up in a controlled manner. Essentially, it's really about confidence. So if that happens, which is why we're seeing, I suppose, airline stocks, Singapore Airline, recovering. Basically, the point, and probably David has more view on this one. We know that it will be still suffering losses. Essentially, is the burn rate going to be, improving significantly more so? So it's buying in anticipation. So I think this will be, what investors will be looking for in terms of what's the macro backdrop, and obviously apply them to the stocks individually or sectors as we go along. And very much will depend on the COVID news flow in the coming days, weeks, and even month.
Yeah, because the SIA management is obviously quite confident about things going ahead too. They're restarting daily flights to the US. So clearly they're seeing something in the future. They're obviously very confident. David, we're going to go to you right now. There's actually a question from one of our viewers asking if stocks have peaked. Are they at the peak right now? So we'd like to ask you about valuations, David. Lots of people are looking at the market and thinking, wow, everything looks so expensive, a bit less expensive after this week. But what would you say to them, David?
Well, Edward, and to the questioner, probably less so this year, but in previous years, you remember that we had this thing called the Bak Kwa Index, right? I mean, it was how much you paid for that piece of barbecued pork. And generally around Chinese New Year, prices go up. The rest of the year, they're actually cheaper. So if you are approaching Chinese New Year and you haven't bought your Bak Kwa yet, and you have to go out and buy, you say, oh my goodness, it's so expensive. And then you can't go home without taking any bak kwa or giving it to your friends. You have to buy it. And what do? You have to stomach it and you have to say, right, it's more expensive than a month ago, but I have no choice. I have to go out and buy it regardless of the price. And I think that was really what was happening with the stock market. Maybe we should have a Bak Kwa index for the stock market, but thankfully we don't, because we have valuations. And if you have a look at valuations, yes, they are expensive. You look at the Dow Jones, it's trading on a PE of about, call it 30, right? Because it's nice and easy to work out. Now, what a PE of 30 means is that if a company were to pay out all of its profits as dividends, that would equate to a dividend yield of 3%. And you would say, well, where else can I get a 3% yield on any cash that I have? Stick it in the bank, you get 0. Stick it in bonds. Previously, you were only getting 0.5%. So you would say there is no alternative, which was really the phrase back in about 2007, 2008. Tina, the girl, T-I-N-A stands for there is no alternative, right? And we come into 2020 and I came up with Tina's cousin called Trina. There really is no alternative, right? Because there was nowhere else to put your money. So consequently, people had to go into the stock market, regardless of the valuation, because there really was no alternative to the stock market if you wanted some kind of yield. We are now seeing perhaps there might be an alternative because bond yields are going up and that is unsettling the stock market. So what I suspect is that there were lots of reluctant investors, people who didn't really want to be in the stock market, but because there was nowhere else to put their money, they had to go into the stock market, and that drove up prices. Maybe we might see prices coming down a little, but back to the questioner, have we peaked? Peter Lynch once said, nobody rings a bell at the top and the bottom of the market. What you can say, though, is where will stock prices be in 10 years' time compared to now? And what I suspect is in 10 years' time, whatever stocks I have in my portfolio will probably be higher. The price will be higher in 10 years' time than they are now, because these companies are good companies and they're able to grow their business. If they can grow their business, then of course, they will be rewarded with a higher market capitalization. In other words, they'll be worth more in 10 years' time, and consequently their share prices should be higher. So I go back again to what I said earlier on about the best time to buy is yesterday, and why I am a long-term investor, because I believe in these companies. Some of these companies in my portfolio, Edward, are so old now. I mean, they've not only grown whiskers, they've grown beards, right? Because they've been in there for so long. They've been in there for 20, 30 years, Edward, and they're still there today, and they will still be there in 10 years' time, because these are great companies, obviously great investments. And that is the way I invest. And are valuations high? Yes, they are. But ask me in 10 years' time, will they be worth more? The answer is probably yes.
It's interesting that you mentioned 20, 30 years, because some of the stocks, the tech stocks that were supposedly bursting at the peak of the dot-com bubble 20 years ago, right now, if you look at 20 years ago, they look horribly undervalued to where they are right now. So yeah, if it's a great company, it's a great company. You should hold on to it for a long time. Thanks for that, David. Geoff, we're going to come to you right now and ask you about that. Valuations, your thoughts on Singapore, and have we peaked?
Well, I mean, okay, let's look at the banks, because OCBC and UOB did report this week, and DBS reported their full year a couple of weeks ago. And look, the three banks, Mike Sin in the opening speech mentioned the word resilience, and these three banks have definitely displayed resilience. They've together reported combined net interest income of more than $5 billion a quarter ever since the first quarter of 2018, okay? The trio have also ended FY20 with a return on equity of 8%, which is above the 7% median for all the global banks and the APAC banks. But the key thing is the trio are now trading, when you look at the median, the average book value, they're now trading at book value. And that's after trading at a 15% discount at the end of October. But we also saw a similar snapback to book value for the top quartile of banks by market value. Now, while the Singapore trio are at the book value now, they're well off that premium, that 40% premium to book value that we saw in the first quarter of 2018. Now, what followed, what the first quarter of 2018 followed was the year 2017. And in the year 2017, the Singapore economy was amongst the strongest advanced economies across the world. It had also, I think, the first equal best performing stock market across the world for all the major economies in 2017. And hence the valuation premium, it did seem justified at that time based on what we could see around us. So that, back to the person's question, they should be able to make a judgment call based on where we are at the economy, in the economy at this particular juncture, to justify that valuation, particularly as the banks do have so much sensitivity to the economy around them. Now, for Singapore Airlines, which you mentioned before, yes, it's been the strongest of the year, and I think SATS is very strong behind it. It did release a business update, I think, some time ago, only a couple of weeks ago, that they saw a quarter-on-quarter increase in group passenger capacity and passenger carriage for that third quarter. and they estimate that they will be at 25% of their pre-COVID capacity in April, and back to 45% of those COVID city links, which, as you noted, include the US. But look, SATS has, I guess, it narrowed its third quarter loss, I think, to just very close to $3 million. That did beat expectations. But for the moment, valuations and sector moves, they are so in line with what we're seeing globally. As I said, because of the overarching impact of the coronavirus on the market, so many of the world's sectors, whether it's consumer, travel, financial services, industrial, healthcare, utilities, and so forth, are seeing these high correlations across the world.
Thanks very much for that, Geoff. Our next question will be a bit related to what you've been talking about, because we are looking at a possible sector rotation right now. People are looking at the economy getting better. Some of these industries that have been absolutely smashed by the pandemic are roaring back, but not in real life. Their businesses are still losing money, but the stock market is valuing them very richly. So the next question a viewer has is about S-REITs. It's not been a great year for S-REITs, but are we looking at a possible recovery? I'm going to open this up to the entire panel. Let's start with Seng first. So Seng, if we look at the REITs in Singapore, which sectors do you think are going to do better from here?
Well, we are a small open economy. So simply from the macro standpoint, if the rest of the world gets healthier, entire Singapore economy get lifted. Earlier, just to write on Geoff's point about Singapore's economy at 2017. When we head into 2019, we already knew we are at the late stage of a very mature growth cycle. We knew that it's on the verge of a correction. We don't know what could trigger that. In the end, it turns out to be a pandemic. Now we are on the start of the new growth cycle. So in terms of looking at industries and sectors, it's really about, as I said earlier on, normally, at the start of a new growth cycle in Singapore, we roughly go through one cycle every 10 years or so, which is why the last cycle was actually quite protracted from the 2008-2009 global financial crisis. Very protracted. We don't know what would trigger it. It was the pandemic. Now we are starting on a new growth cycle, to repeat what I've said earlier on, but it's uneven. So in terms of where we are going to be seeing interest rate coming off from the low, very depressed level, but we are at least heading towards, some sort of normality. We are still far from normal in terms of interest rate environment. Will it ever get back to normal? Not quite sure yet. Yes, we still have inflation fear at this moment. I think it's premature at this stage, mainly because in the economist jargon, there's still negative output gap over there. That basically means there's still slack in the economy. Not just here, but around the world. So inflation risk, though, is there. We must remember prices are coming up from very depressed level. So yes, inflation will tick up, but there is still slack. And once the factor which have driven up some of the prices recent months, more to do on the supply side disruption than a strong, robust recovery on demand. So what's the interest rate environment? I will still say it is very mild. Yes, it's not quite as depressed, but we are not talking about a steep climb. It's more gentle, I would say. Current sort of a week, we may have overshoot in terms of inflation and inflation fear and interest rate fear at this point. So I would say, as far as the interest rate sensitive stocks, I think too much fear is being placed on rates increasing sharply over the near term. To me, it will adjust. It's more gentle than that. And looking forward, really looking at cyclical stocks, sectors, getting that lift as we move on to a new normal, a start of the new growth cycle, which should lift everybody, whether you're talking about banks or whether you're talking about the property sector or the interest rate sensitive area, etc. as well. So that's my 2 cents worth on that. But otherwise, David is the right person as far as REITs is concerned.
Thank you for that segue. So David, we're going to come to you because interest rates going up, not a great thing for REITs in general, right?
Really? Really, Edward? Seriously? Did I really hear you say that?
No, a lot of people think that.
Okay, right. REITs will do well unless two things happen, right? And the two things are we get an economic slump, and some people might say that, yeah, the economy is not doing well. And the other thing is there is no liquidity in the market. In other words, the REITs are unable to finance whatever loans they have. We have to remember that REITs need to borrow money in order to finance all those lovely buildings that they have. Now, both those things have to happen simultaneously for REITs to do badly. Now, the last time it happened was back in 2007, 2008, when we had the great financial crisis. We had the banking crisis, which sent the global economy and also the Singapore economy downwards. And we also had a credit crunch. In other words, the REITs were unable to finance whatever loans they had. And that was when REITs did badly. We can't say the same thing in 2020. Yes, the global economy is not doing well, but you cannot say there isn't liquidity in the market. If anything, I mean, we probably haven't even taken back the amount of money that was printed and pumped into the global economy in 2008. And at that time, they printed about what, 15 trillion US dollars? And this time they printed another 18 trillion dollars. So add it all together, you got nearly 30 trillion US dollars of cash just floating around. So there's plenty of liquidity there. And as to why people are interested in REITs, it's because the market is forward looking. People sometimes suffer from recent event syndrome. They say, oh, you know, the shopping malls are empty at the moment. Everybody's working from home. So let's get rid of the REITs. Well, that isn't going to happen next year and the year after. The economy is going to come back. And people are going to go back into the shopping malls. And I'm already seeing a lot of people in shopping malls now, which is why you have those social distancing ambassadors there, making sure that people are keeping a safe distance from each other. If there was nobody in the shopping malls, you wouldn't need the social distancing ambassadors, would you, right? So, I mean, human nature is such that we are gregarious. In other words, we like to go out and meet people, and we need to do it safely. But as far as people going back into offices, they will do eventually, probably not in the same numbers as previously, but they will do. As far as shopping malls are concerned, people will go back. And we mustn't lump all the REITs into one basket. There are all kinds of REITs out there. Companies like Keppel Data Center REIT, Keppel DC REIT, operates these data farms. So they're doing quite well. Same with the industrial REITs, they are doing quite well. So if you have a basket of REITs, yes, some of them haven't done well in 2020, but not all of them did badly. Some of them did exceedingly well. Things like Parkway Life did reasonably well. And there were also others like Mapletree Industrial, they did well. So don't fall into the trap of sometimes categorizing everything into one basket and saying, oh, you know, let's leave that alone. Within that basket, there are going to be some good eggs and some bad eggs.
Thanks very much, David. And thanks for that reminder. Folks, if you're viewing this and listening to David for the first time, he is the reason why my stock portfolio has become really diversified, listening to him through the years. So yes, diversify, absolutely. Don't concentrate on sector risk. But talking about specific sectors, we're going to go to Geoff now. Because Geoff, when we talk about recovery, people straight away think, hospitality, retail. Are those the REIT sectors that you think might do better in the year coming ahead? Oh, Geoff, you're still on mute, I think.
Thanks, Edward.
There we go.
You can always turn the book back to November and look at when we had that incredible rotation. You can see, okay, which stocks, which REITs, I should say, benefited the most. And yes, you're right. The hospitality trust, the staple trust with the hospitality hotel assets tended to attract most of the institutional inflows during that period. Look, for the REIT sector, though, overall, it's still incredibly vibrant on a day-to-day basis. You know, I mean, I can give you all the long-term stats, such as the 10% annual compound growth rate of the value of the sector over the past 10 years. But I think more to the point, now REITs make up around 12% of our total market cap, but they double their impact on the day-to-day turnover of the market. So investors are still quite very active with REITs making up 24% of the day-to-day turnover of all our stocks listed on the exchange, excluding the ETFs. But in terms of growing the basket, the REITs are still doing that too. And look, the ongoing securitization of real estate assets does continue to be a really key theme for the REIT sector. I think just last week, Keppel REIT launched a $270 million placement in order to acquire, I think it's Keppel Bay Tower from Keppel Land, and that placement was almost 5 times covered with very strong participation from new, existing institutional accredited investors and so forth. So the sector it's very much a global REIT hub now in Singapore, and it really it's a nice little microcosm, if you will, for the broader stock market, because you have very diversified sectors, the retail, the industrial, the commercial office, the residential, the healthcare, the data centers, and high tech, to cover a lot of them, including the hospitality trust. But not just that, you also have very diverse and significant geographical reach. So you have REITs with properties all over Asia Pacific and now over the world. So you're able to basically map out a real estate investment across all the different property types, across all the different countries, and you can basically map that according to your outlook for a certain part of the world in terms of its property. I should also note that the REITs have basically haven't been so strong this year, and I think what to really sink home why it's you look at Keppel DC REIT, for instance, that was the strongest of the REITs last year. For most of last year, it was amongst the top 20 performing REITs globally for REITs of its size. And if you look this year, particularly for the month just gone, February, it was one of the least performance. It was the least performing REIT in February. So what's happened so far this year is there was a lot of gusto in the market and optimism in the market at the end of December. And some of that optimism has come out somewhat, particularly with the resurgences that we saw in Europe and the US with the coronavirus. And hence, you're seeing a little bit of consolidation now across all the asset classes. And I guess that is really being played out in the yield curve too. In the US, you've got 2-year yields at around 0.1%. You've got your 10-year yields at 1.4%. So your yield curve is now at a 4-year high. Now, what's that signaling is that there could be some money coming out of the stock market, potentially going into supporting the long end of the yield curve in the US. In terms of that's what we've seen. That's what's possibly happened over the last couple of weeks. Possibly in, it could be money going to work there on the I guess the trading idea that the Fed Reserve might be looking at some yield curve targeting in order to bring the 10-year rates down. But ultimately, all that's telling us is 2-year yields remain very low, 10-year yields are getting higher. At some point in time between the next 2 and 10 years, the fixed income markets are pricing in a recovery, an eventual recovery out of this coronavirus. We haven't seen the full recovery yet. Obviously, we need to reach a new multilateral norm and open our gates, and then it will be a different type of paradigm for the market.
Thanks very much, Geoff. Also a reminder to our viewers that the SGX actually offers REITs denominated in euro that invests in European properties, European REITs. We also have US dollar denominated REITs that allow you exposure to the US market for property and real estate over there too. Now, next question is for Seng-Wen. Seng-Wen, there's a question from one of our viewers about US bond yields, because that really does affect everyone globally. Is it going to keep going up? That's the question.
I suppose just to recap what I said earlier on, we are on the start of the new growth cycle. It's still extremely uneven. Theoretically, when you have so much stimulus in the system, too much money chasing too few goods, we should see inflation coming through. But I say at this point, still, there's still slack in the economy. The US job markets, though less bad today, is still relatively weak. You're still talking about jobless claim pre-crisis, average of about 200,000. We are still very, very high. We have seen, obviously, data last night on income and spending spiking. That's because of the support from the government, that basically to keep the economy going. So bottom line still is, yes, we are and we'll see inflation ticking up from a very depressed level, but it should still be on a gentle path because of the uneven recovery. So that's, I think, still the same thing as I said earlier on. In terms of US interest rate, yes, yield has steepened. We have seen this before. If you recall, back in 2016, just after President Trump got elected, there's a lot of hope about stimulus, there's a hope about tax cuts, etc., lifting the economy, and we did see a yield steepening for a little while. Then it came off again as we sort of see that global growth is slowing down, trade war likely to be a risk. We may see a little more mini replay of that as stimulus are likely to be rolled out. I think the US, I think the Republic, I don't know whether they have passed the bill yet. They're supposed to be debating and pass it today, at least at the House of Representatives side. And that may be what market has been hoping to give the economy, the US economy, that lift. But I would say these are the little things that may continue to keep the economy going, but it shouldn't translate into widespread sort of inflation fear that see further steepening in the yield curve. It will normalize, but it's not quite as straightforward as that. So I would say a little inflation is good, as David pointed out. Everybody needs a little bit of inflation for price and profit. Deflation would be a worse alternative. So mild inflation and mild interest rate, I think, is good as we start on the healing path to a more broad-based recovery.
Thank you very much for that, Seng. And also, it's a $1.9 trillion package, so the impact on the market should be quite significant. Nobody knows for sure, though. Next one's for David. David, we have a viewer who's interested in those stocks you've held for over 2 decades. They'd like to know some names, please.
Okay, well, I'm not embarrassed to sort of say that Unilever has been in my portfolio for a very, very long time, right? Well over 20 years. And why do I like Unilever? Because it makes the stuff that people can either easily afford or the things that people can't do without. So during a pandemic, we still need to wash our clothes, right? Well, hopefully we all still need to wash our clothes, even in a pandemic. You don't suddenly say, oh, I'm not going to do any more laundry because we have a pandemic. You still have to go out and buy soap powder in order to do it. So I am a proud owner of Unilever. And then you have the rival, Procter & Gamble. What is so wrong with Procter & Gamble, right? I mean, it makes the same things as Unilever does. Then you have another company like Reckitt Benckiser. Now, it makes a lot of the cleaning materials that we use. Now, clearly, at the moment, as far as the pandemic is concerned, people are even more keen to clean their homes. So they go out and, buy all these cleaning materials. But the reason why I bought it wasn't because 30 years ago, I could foresee the pandemic coming, in 2020. The reason why I buy it is because, I mean, these are consumables. These are things that people need to buy on a regular basis. Then you have things like pharmaceutical companies, things like companies like GlaxoSmithKline. Part of the reason why I bought GlaxoSmithKline many years ago was because it made a medicine that I required. And it's not that I have some kind of incurable disease, by the way. It's just that, it was something that I needed. And so I thought, well, rather than just give money to the company, why don't I buy shares in the company as well? If you like the company's product so much, you might as well buy the shares in it. And again, Glaxo has done exceedingly well, not because of the pandemic, but because it is a company that is going to be around for a long time. Now, I don't know if your viewers can see behind me, but I've got this scroll. And this scroll is my family tree, right? It goes back hundreds of years. And it reminds me every day that I am a custodian, not for my portfolio, but certainly I am investing for my children, my children's children, and for many generations to come. And when I look at that, I'm also reminded of something that Warren Buffett said. There are two rules to investing. The first one is don't lose money. And the second one is don't forget rule number one, right? And it is the same when I buy stocks. Don't just jump into a stock because it's going up, because that's the worst reason for buying it. Buy a stock because you have confidence in the product and also the services that that company is going to provide, and make sure it's going to be around in many years to come. It may not be in the same form as it is in many years to come, but it will still be around. And there are so many examples of companies that have that staying power, companies that have been around for hundreds of years, if not more.
Thanks for that, David.
And that's not, and that's not, and just to jump in there, so just a reminder of the current sort of retail trade. That's the reason why none of us own GameStop.
Ooh.
Oh, speak for yourself, Seng. Yeah.
Ooh.
No, I don't own GameStop.
Okay, no BlackBerry, no AMC, no GameStop. But Geoff, having just heard from David, and I'm sure many of our viewers would hear from him and think, oh, that makes sense as sort of investing philosophy. So on the SGX, which counters do you think we could look at that could play into that sort of strategy that David has just laid out?
Well, I guess look at the stocks that are actually trading. So for as David and myself have basically reiterated many times, index investing is one of our best aspects in the stock market. The ability to invest in an ETF that tracks an index, which by definition will over time always include your biggest and your most active and your most best performing stocks. It should be over a long period of time, not necessarily best performers, I should say, but stocks that rise to be a certain market level or maintain a relative market value capitalization compared to the rest of the market. So in Singapore, we have our 30 STI stocks, which are amongst our biggest and most actively traded. And that kind of can suit as a core investment. And then you can also diversify over different asset classes using the exchange traded funds. You can invest over different indices and so forth. But I think it's interesting to always see what stocks basically trade with high turnover every day consistently, yet are not yet in the STI stocks. And you'd probably be amazed that while we've got the 30 STI stocks, when you rank all the turnover on a day-to-day basis, between the STI stock that has the most turnover, which is DBS, and the STI stock that has the least turnover, Dairy Farm, you've got obviously the 30 STI stocks, but you've got almost another 30 non-STI stocks that are seeing strong participation on a day-to-day basis. The biggest of which is AEM Holdings, which ranks as our 17th most traded stock. And AEM Holdings, I should also mention, was the best performing tech stock globally for all tech stocks with a market cap currently of more than $500 million US since global tech stocks were re-rated at the beginning of 2016. So AEM Holdings is part of those non-STI stocks that have a lot of trading every day. There's also the Zhejiang Chemical, China-based chemical company. You've got Fraser Logistics Commercial Trust. You have Sembcorp Marine in there, Suntec REIT, Keppel REIT. I think iFast is now in there. The UMS Holdings is there as well. ISDN Holdings, Fraser Centrepoint Trust, Medtex International, Top Love's also amongst our top 40 traded stocks. You've also got even our home brand fiber network, the Netlink NBN Trust, Capital Land China Trust is in there. I should say Capital Land China Trust is in there as well. Nanofilm is our new IPO homegrown success story that listed in at the end of 2020. It now has, I think, close to $3 billion in market capitalization. You've got Thomson Medical also this year amongst the top 50 stocks, Mapletree, North Asia Commercial Trust, and then you've also got Riverstone, Shengxiong Group, Manulife, the US REIT, Ascot Trust, UG Healthcare, and even Rex International, down upstream oil and gas player. Those stocks I've just relayed are all trading volumes so far this year, or turnover, I should say, this year, that are within the range of turnover of STI stocks. So, as I said, there's a lot in our market to look beyond the benchmark into, and I'm hoping that for the remainder of the day, and I'm sure it will happen, that we have a lot of really great educators that will help the investors to be able to look beyond the benchmark and find a way to be able to follow these stocks.
Thanks for that, Geoff. And for the viewers who are just like, oh my goodness, I couldn't type fast enough to take down everything that Geoff was saying, not to worry. There's going to be a replay on this same platform after the event ends. So you'll be able to watch this again, slow it down and listen to everything Geoff is saying. We're going to go back to Seng now. This is the final question actually for all the panelists. There's actually a worldwide semiconductor shortage. Nurul, one of our viewers, is asking about your views on that and what that means for us, not just for the stock market, but also for the economy in general.
Very simple, good. Singapore's tech sector, semicon in particular, is in a very, very sweet spot. I got friends in the semicon industries, and they were working through Chinese New Year, working through the weekend, because there's really a very strong demand for products that goes into consumables, whole range. Whether you're talking about autonomous driving or a simple vacuum cleaner that you've got or planning to buy, there is, just cleverer appliances out there that requires the chip. So we are seeing, I think, a start of a new growth cycle for the semicon industry itself. How important it is for Singapore? We are talking about Singapore manufacturing. I'm simplifying it. 20% of our GDP, of which, within the semicon, the chip sector itself is really about 10%, almost of that. Really large segment in terms of a contribution to the overall manufacturing sector, of which we are seeing obviously other sectors linking with precision engineering, etc. As well. So on any other typical month, contribution to our export, for instance, chip can be easily as much as 10-11% of that month non-domestic exports, together with the other one, the biomed side, pharmaceutical product, semiconductors. Those two key export items, easily 22 sometimes % of the monthly non-domestic export. So this is where it gets interesting going forward. That these are the two sectors that is likely to still do well this year. And we may see upside surprises from their export figures to the industrial output figures, which basically mean that contribution to the GDP could continue to surprise on the upside. Currently, we are seeing government forecasts, our forecasts are as well. Base case, as I said earlier on, 60-65% probability of growth within that 4 to 6%. I'm quietly confident that we may surpass and see growth on the higher and larger than this, just because of contribution from both the tech, semicon in particular, and the biomed cluster itself. So I'm quietly confident, at least from one particular sector, the manufacturing side, global demand for these products remain strong, and we will see them lead Singapore growth higher. But again, while the number on the surface looks good, we still see uneven recovery across, and we probably will see again aviation, etc., still lagging behind. But in terms of contribution, in terms of jobs, in terms of confidence on the economy, on the broader front, whether it is in the property sector or on the job market, I think it should be quite positive for the overall economy, and in that sense, translate into the market sentiment as well.
Thank you very much, Seng Woon. I'm afraid we're running very short of time. So, David, we've got about a minute for you to talk about that. Semiconductors, pharma, how would you play that? Well,
don't play it. I mean, seriously, I mean, just have a look at the companies and sort of say, are these good, solid companies to be invested in? And I think, Seng Woon was absolutely right. Chips are going to be part of our lives for a long time. From the moment you wake up in the morning and you get your electric toothbrush out, there's a chip in that, right? And then throughout the entire day, there's chips with everything, right? Guess what? I'm going to be having chips later on, chips with chicken, I think, yeah, later on. So chips are going to be part of our lives. And if you want, have a look at some of the manufacturers. Yeah, things like Taiwan Semiconductors. I mean, that is a good company to look at. But ultimately, look at the chip designers. That is where the money's going to be. The people who are designing these chips, because chips are very clever. So I think I'll just end on that note and just say that chips with everything, including later on today, maybe chips with my Migo ring, I think. Yeah.
Thanks, David. That's a quote. David Kuo, chips with everything. Geoff, final word from you.
Yeah, look, in terms of that, like you said, the global demand for semiconductors with the car manufacturers obviously outweighing the supplies. Look, the integrated circuits and the semiconductors, there's a very wide increasing field of application. And we should note that this shortage that we saw at the beginning of the year, it was not necessarily all unforeseen. I remember semiconductor company UMS Holdings, the CEO noted last year with the first half FY20 numbers that basically he did signal potential supply constraints as well as the trade tensions and currency volatility back then. So it means companies that who have basically foreseen this were able to, I guess, stay prudent, sharpen production efficiencies and their supply chain networks and so forth. But to sum it up in the next 30 seconds, the manufacturing sector makes up a quarter of Singapore's economy. It also makes up a quarter of our most traded stocks on a day-to-day basis. If you look at the 30 most traded manufacturing stocks here in Singapore, they made up exactly 25% of our day-to-day turnover in the first month of January. And they span multiple sectors: consumer non-cyclicals, industrials, healthcare, material and resources, in addition to technology. So there's a wide field there, and last year they were also amongst our best performing stocks in the market. The manufacturing 30, if I call them that, those stocks generated a median gain of 27% last year. So like the manufacturing sector in Singapore, which grew 7%, and following a cyclical downturn in 2019, and guess what? Semiconductor stocks also had a cyclical downturn in 2019. They have followed, I guess, the manufacturing growth curve quite somewhat in 2019 and 2020, and hence what we see in terms of the EDB numbers that came out yesterday. You can see that the K shape in the growth in the electronics and semiconductors and medical supplies, it's starting to fuse a little, sort of like disbanding the K shape when you compare it to transport engineering and general manufacturing. It's starting to I guess have less of that K shape, less of that unevenness now. So it is a very vibrant sector in itself, Singapore manufacturing stocks. And if investors want help in identifying those manufacturing stocks, I know our brokers are very proactive in their reporting on the various manufacturing stocks as well.
And don't forget, ladies and gentlemen, you can check out Geoff Howie's My Gateway report from SGX. Definitely sign up for that if you haven't already. He does talk about that. Seng, of course, reminding him that it's not just one shape, he's got a palm, so they're all in different directions. Thank you again. I'm afraid that's all the time we have, but thank you again to our esteemed panelists, Mr. Song Seng-Woon from CIMB, Mr. David Kuo from the Smart Investor, and Mr. Geoff Howie from the SGX. Remember, folks, there is a $5,000 cash top prize up for grabs from our simulated trading competition that runs next Monday to Friday, March 1st to 5th. Do sign up for that if you haven't already done so. And next up, hit the button that appears above at the top of this page, because we're moving on to a fireside chat with Jack Schwager, the author of the best-selling Market Wizard series. He'll be speaking with Philip Teal, the founder and CEO of TraderWave.com. Don't miss that. Hit the button now, and we'll see you again very soon. Thanks.